Thank you for coming. Not many of us, but it's good. I have no doubt you probably heard the shocking news. Matthew, our chapter president, he was partying last night until 3 o'clock. So we'll see the result today. Yeah. Thank you for being yesterday night in the Tower of London at the gala evening. And the good news about this event is that the crowns are still there, although we were all tempted to try. Okay, it is my great pleasure to present you Alan Gamp, who is the SIOR Global President. Alan earned his Society of Industrial and Office Relators designation in 1991, and he's actively involved in the organization ever since. He's been in many committees for this time and served various national and international committees. Professionally, Alan is the part of the Logistic and Transportation Group at Colliers. He has specialized in working with corporate tenants, leasing and purchasing warehouses and tracking facilities in Texas. For European chapter, Alan is a great friend. He is a supporter and believer in this conference. So we are very lucky to have Alan here. May I welcome you on the stage, please.
Thank you. Well, good morning, everybody. For anybody who's been here for a long time, there's even bigger shocking news, and Cleveland Cavaliers did win the NBA championship. And I can tell you the Vegas odds were a hell of a lot bigger on that than it was Brexit. So, but anyway, I was originally told I would have 15 minutes for comments, but Matthew explained to me with the exchange rate, that's down to 4 minutes. So. Some of you have already seen and experienced some of the outcomes of our initiatives at SIOR. We're currently in the first year of a 3-year organizational strategy defined by 5 strategic goals: increase member engagement, strengthen the SIOR brand, create a data-driven decision-making organizational structure, position SIOR further as a thought leader in the commercial real estate industry, and increase chapter engagement. And I don't think there's a better way to increase chapter engagement than this event right here. So we're extremely happy and proud of what the European chapter has done. The rollout, some of the things that we've done this year, and it wasn't just this year, these things have been building up for the last several years, but we rolled out, of course, the new logo, an SIOR brand, which includes, of course, the pins, the new advertising campaign, the new marketing chapter marketing templates, just to name a few. The use of beacons at conferences to gather data on attendee behavior. This is basically Big Brother watching. But it helps us to see what our members are doing, where they're going, and ultimately increase and enhance the attendee experience in the future by knowing better the behaviors. We also are doing really better conference, segmented conference marketing to highlight the sessions that we think might appeal to certain members in different groups. And we also are doing another white paper with IAMC to be published later this year to further position ourselves as the thought leaders in the industry. And that's just the beginning. As we continue through 2016 and beyond into 17 and 18, we've got metrics for success in each of these goal areas that we've created in order to help measure and ensure that we're achieving these goals. So hopefully we'll look for more information in the future. I also just wanted to comment and just say that the board, the SIOR board and the governance committee, who, by the way, are here in support. I don't know if everybody made it in from last night, but Dale Marquardt, Jeff Castleman, and our future Vice President, Robert Thornburg, are all here in support of this great historic event, and we could not be happier. We're also grateful for the effort of so many that have gone before us, that have made the decision years ago that if we were going to be global, we needed to make a commitment, attending MIPIM, and so forth. And by the way, I would just also mention to you that that is something that we really do feel committed to in the future, to continue that involvement with MIPIM. But we really do want and ask for the help of the European members. And this year was a great MIPIM conference. We had so many of the European members with us at the booth, and we hope that expands and continues and expands to all the members to attend MIPIM with SIOR. It really helps increase our presence, and so we would hope that that would expand and continue. Also wanted to mention one other thing. Last year I got the opportunity and privilege to go to the first ever chapter event for Mexico City, and I have been just extremely pleased. I don't know how many are here. Those guys do party a little harder than anybody I've ever seen. There's Rafael. But yeah, I just think it's great. So many of the members from the Mexico chapter are here in support of the European conference. I've seen just quite a number of them here, but I got to go to that, and that's really cool, and it's neat. So just in closing, again, I want to thank so many of the people. I'm not going to try to name names, but so many of the chapter members that have gone to a great lengths and a lot of effort over a long period of time to pull this together. In addition, all the SIOR leadership that made the commitment with SIOR that we were gonna make Europe happen, and we just couldn't be any more pleased with how this has turned out. So now let's get started with this morning's program. We are fortunate today to have Colliers International as today's session sponsor, and I'd like to thank Colliers for their support of the conference, SIOR and the SIOR European chapter. I'd like to introduce you today to the session moderator, Richard Divall. Richard is the head of cross-board capital markets with EMEA at Colliers International. So, Richard.
Thank you very much. Good morning. I'm still a bit shocked. I went to bed feeling that we were in Europe and woken up out of it. So it's going to be very, very difficult to talk about what we're going to plan to talk about today, because I think everyone wants to hear what's going to be the view and where real estate's going to go forward. But we've got a great panel, and in particular, I want to highlight that we've actually got a German colleague here as well. So we're still friends at the moment, which is good. So I'm going to get each panelist to come up and introduce themselves in more detail. But just to get them up. So first of all, I'd like to introduce Philippe Lapierre, who is the head of investment management for Union Investments, which is a German open-ended fund. Yeah. And then secondly, I'd like to invite Alistair Dixon, who's based in London. Alistair used to head up a German fund and is now the chairman of Azimuth, working with a lot of Southeast Asian investors. And finally, John Baines, one of the characters of the European market. He works currently at Farebrother with CORFAC, which I think a lot of Americans would have heard of CORFAC, and is currently a partner at Hobart, which is a private equity firm based in London. So thank you all, first of all, for joining us. I was going to talk about and give a sort of background to the European real estate market, but I suppose, everyone wants to talk about Brexit. So what I did is we got Roger Bootle, who's one of the best UK economists, just to send through some of his thoughts of what's going to happen, whether we had a firm remain, a weak leave, or a firm leave. So, I thought I'd leave it to the experts to do. So quickly, his view is, we're going to have an EEA-style free trade agreement seems the most likely scenario. Are we going to go down the Norwegian model? Are we going to go down the Switzerland model? We're not quite sure. But, his view is the Article 50, which is the notice period, will not be triggered straight away. The EU will offer a renegotiation package to avoid withdrawal, but personally, I don't think that's going to happen at all. You know, it is an absolute nightmare that 1.7% above 50% is going to cause absolute chaos in this country. You know, economic effects, output's going to be way down. The rate rise will be delayed, but there won't be any cut in interest rates immediately. I don't know if anyone's been following the press, but apparently Cameron is resigning already. So there is going to be a leadership election held. Boris Johnson is probably going to be the winner out of this. So we will potentially have the Donald Trump-Boris show going forward, which could be interesting. You know, with Putin, who's going to push the button first? It's very worrying, isn't it? But anyway, you know, the political scene, you know, the bottom line is it's an absolute economic disaster for the UK. You know, no one knows what's going to happen. It's going to take probably years to sort out, but it's also a political disaster for the property, for the European Union as well. So, you know, there's going to be a lot of people thinking, well, who's next? So it's just going to create a lot of uncertainty in Europe, and I'm quite embarrassed to be British at the moment. But, you know, it could also mean the breakup of the UK. So, you know, the Scottish, I don't know if anyone looked at the map, but it was all London in and Scotland only. So it really shows that in London we live in a bubble, and, you know, does it mean that Scotland will want a second referendum to vote out, which could easily be followed by Northern Ireland and potentially Wales? So a lot of uncertainty. It's not great. The market impact, he reckons the sterling's going to fall to about $1.20. Interest rate cuts priced into. There's going to be falling gilt yields and equities under renewed pressure, but lower cushions blow for the FTSE 100. So I've already looked. The FTSE's already down 100. Obviously, the Dow Jones is up, but no one's awake over there. So it's going to be very interesting trading this afternoon. So I think, you know, at the end of the day, I think we're all in a state of shock. A lot of my friends are already thinking about where they're going to go for a drink at lunchtime to commiserate. You know, everyone's like, have I still got a job? I'm only happy that the bookies, which always get it right, were 7-1 that, on the odds, and 1-7 that we would remain. So I'm quite happy I put some money on yesterday lunchtime at 7-1. So the bookies never get it wrong, and they've completely got it wrong this time, which is why we're all in a bit of a state of shock. So just moving on, you know, as I say, I wanted to really sort of get the panel to discuss their thoughts on, you know, where the European real estate market is. But I suppose we're going to have to sort of get everyone's view of what were your thoughts pre-Brexit, what are your thoughts going forward. You know, we've got very good guys here who look all over Europe, so, you know, some of the brains of the European property market. So, first of all, I'd just like everyone to just introduce themselves in a bit more detail. So, I don't know if, Alistair, you would like to go first, just to explain who you are.
Good morning, everyone. First of all, I'd like to add my thanks and, I guess, just general praise for the organisation here. I have lived in London about 30 years, and I have never been in the Tower of London, so... and rather remarkably, I got locked in it as well, which was like really weird, like, how can I not get out the Tower of London? And I just thought it was an amazing evening, and so a really great event, and the whole organisation has been fantastic. So great thing to attend, so thank you for inviting me. My background, I spent my formative years at Bankers Trust. I worked in 280 Park Avenue for a couple of years, and then came back to London and started their private equity real estate group. That was a relatively small business at the time. It grew to have about $1 billion of equity invested. We then sold that to CalPERS and to Sturs, and then we went into third-party management. Along that whole history, I worked across many different areas of Bankers. But then I specialised in private equity real estate. And I then became co-head of Deutsche Bank's European high yield business, and eventually climbed the slippery pole and became global head of their high yield business with about 100 billion under management. So it's quite a large sort of scope across all the alternatives business. So as Richard said, I've spent a lot of time traveling around the world. I've invested in most of the continents of the world, rather strangely not South America. I don't know why, just a place we didn't invest in, but I invested in China, India, Japan, all over Europe, all over North America. So I have quite a lot of experience of most of the markets. I think Richard's sort of done a good intro about I'm in a state of shock in the sense of, I believe I'm a European and not a Brit. And I'm no longer a European, unfortunately, I don't think. And I think we just need to try, and we'll try the best we can, to put it into context about what this means for investing and our investors. At the moment, my investors are all in Southeast Asia. We've built a little business over the last 3 or 4 years, primarily off the back of sovereign wealth fund capital from Malaysia. And we've invested in some of the alternatives as well as the traditional sort of real estate sectors, particularly in medical healthcare, which we were able to invest quite a lot of capital at a very down point of the market. So I can give a pretty good perspective where I think the Asian capital will be moving or not moving, as the case might be. I think probably not moving at the moment, but I think it's all very positive for the US, that's my initial take, of where their capital will be seeking to invest over the next few years.
Thank you. And then Philip?
Well, that's a difficult one to follow. I'll keep it short. I'm the European in the room, so I'm the one that the Brits wanted to get rid of last night, which they did very successfully. No, I'm a bit heartbroken, really, because I actually went to school here, and even that's not giving me any benefit. Philip Lapierre, I have a background as a lawyer. I was educated in England and have lived across the European continent for the last couple of years, and have worked for different banks like Credit Suisse and ING. And I'm now presently running the European investment team at Union Investment. Union Investment is the central asset manager for the Deutsche, here we go, for the German Volksbanken and Raiffeisenbanken. Now, if you'd like to say that in the chorus, which is it's a co-op banking system in Germany, which went through the last crisis, because now, in my opinion, we could be hitting the second one very nicely. So for all the opportunistic people out there, these are going to be interesting times. We asset manage about 300 billion globally, of which we do 30 billion in real estate, which we also invest globally, primarily via open-ended funds, but also special funds for German insurance companies, pension funds, international players involved in that as well. We have a transaction volume of about 5 billion per annum. A lot of that in the last 2 years, we've increased our business in the US. A colleague of mine called Martin Brühl, who's also the president of RICS. I don't know if you've heard of that. It's not a bad place to be, I guess. But this is so much better. He's going to kill me if he finds out that I've actually been speaking here. But it's an old British, society. So, you might have some opportunities growing that, looking forward. Who wants to follow the Brits after last night? Anyway. Union Investment, but it has a European focus primarily, so 30 billion assets under management. About 18 billion of that is in Europe. It is our home market, Germany, and then growing out above that, trying to grow Asia and Americas. We invest more on the core plus side of the market in all commercial products. So that's offices, retail, high street retail, logistics. That's our playing field generally. We've gone into an added value scenario a lot of the times as well, and what we've done in the past that maybe differentiates us from the other institutional big investors, we've gone in early into projects. So we've got a big technical team, and about 30 to 40% of our investments globally has gone into developments or early securing of sites into forward fundings or forward purchase agreements, which we've gone with quite successfully. In this very crowded marketplace that we've had until yesterday, it's extremely difficult to try to find your bit of the business and still try to get a kind of return that your investors are happy with and to supply with further capital. We're very capital rich. We have about 6 billion of equity to be invested, moving forward in all capital classes. And it was, until this morning anyway, a very lucrative investment or a very favored investment vehicle for the German public. We'll see how that moves on, and I'll be excited to hear both your views and that of the panel of where we think the future of real estate is going to be, in Europe at least, for today.
Thank you, Philip. Yeah.
Thank you, Philip. Good
Finally, John.
Jonathan Baines, British, Welsh, and European. And it's nice to see everyone here in London. A little bit of background for me, I've done both sides. I've been a gamekeeper and a poacher. So I was 16 years with Cushman & Wakefield on the advisory side, building up their European structure. Had 6 wonderful years living in Spain, started the Spanish operation out of Madrid. And the relevance of that was that, that was 89 to 96, is that the SIORs and the RICSs of this world was still early entrance into what was not a very professional market in Spain. And over the last 20 years, it's been helped by groups like yours and the RICS to make commercial real estate across Europe and the world much more accessible and professional. I then came back to London and became the first head of Europe for the GIC, which is the government of Singapore Investment Corporation, one of the largest sovereign wealth funds in the world. And I was looking at both their direct and indirect investments across Europe. And a morning like this, of course, it is extraordinary, because clearly when you are at the top, like with Union or with Alistair's investors, Colliers investors, you look at the political, and then you look at the economic, and then you look at the real estate. And I think we're all absorbing, as Richard said earlier, the shock of last night in many ways. I think we'll all stay friends. We'll all stay in Europe. And I think when I was at GIC, it was the Russian crisis, it was the Argentinian crisis, and there were times at that time when it was the end of the world, and we all got the sun shone the next morning, and it all adapts. And I think that I'm slightly more optimistic, I think, with regard to the UK and its relevance to Europe and the global investment. More recently, CORFAC, which is a professional group of professional smaller firms advising clients across Europe, and as was touched on, quite relevant to this morning, a small private equity real estate group called Hobart in London. Why is that relevant? Because just before Christmas, we were submitting a bid of $100 million to buy a building in London. And there are 3 partners, I'm one of the 3, and we were agonizing as to whether we made the bid before Christmas or first week of January. We were going to exchange this morning. And we did not have a Brexit clause. So if you can imagine, and one of the gentlemen in the room will know a bit more about the detail, but the point of that is that when you look at real estate in London and the UK today, there are transactions, particularly on the capital value side, which have had this, what they call a Brexit clause. What does that mean? That means that if the nightmare that some people would describe this morning as being, i.e. we're leaving Europe, and I think what I personally think is wrong, 3/4, I think, of young people in Britain wanted to stay in. It's the old guys and girls that voted to leave, and that's not for me to discuss. I only had 1 vote. But my point is, young people, I think, are more upset about the vote today than older people, and I think that's rather sad. But the relevance of the real estate is that we didn't have a Brexit clause. So today, after this meeting, we're going to have a big call as to whether we progress with the deal or we don't, and we're not going to go into detail on that. But that is a direct, really direct, and it affects me personally, professional decision going on in the next few hours as to, and that has an impact, of course. You then have the impact, we'll come on to it later, the impact on Europe. We're here to talk about real estate. If London, the UK, then now becomes a hold meaning holding any decision, that has a direct impact on other European opportunities, and Philip's the expert on that. And my final comment for now is with Alistair in Asia. I've done a lot, obviously, from my time at GIC, and countries like China, which are huge, they are incredibly influential. I know Richard travels there a lot as well. Will they, and I don't know the answer to it, but will they now put on hold the UK now that we are out of Europe, in essence? Not technically out of Europe, but you know what I mean, we're still in the football. But Wales, that's Wales, by the way, and England. But my point, and can I just say one last funny thing, which is funny, because we're here to talk serious stuff, but yesterday in the German papers, Bild, which is the German paper, and we were talking about earlier, because our friends in Germany wanted us to stay in, they were doing three things which might be relevant even to American audience here. One was there was this controversial goal in 1966, and the argument was, did it cross the line or not?
Of course it didn't.
And the German, if we had voted, and if we had voted to stay in, which of course we didn't, they would have accepted the fact it was a goal. And the last bit, and forgive me, we are going to real estate in a moment, is that with soccer, football, we always lose at penalties to them, if you understand penalties. And they did promise that if we'd stayed in, which we didn't, they would make sure we scored all our penalties next time, and they'd missed them all. I'm even gutted about that. Should we move on to real estate?
No, actually, John, I'm quite enjoying it, actually.
Let me add two things. First of all, I am German. I know you can tell by my accent that I am. But I'm German, and with the penalties, now we do have the Euros on against soccer, and there's a possibility that Germany is going to play England in the semi-finals. And if you know anything about the history of German and English football, and semi-finals in particular, that bet is now definitely off the table. And we will not block sunbeds with our towels for you either in Mallorca. So that's off the table as well. So you see, this goes far beyond any real estate issues. This gets really personal. But I'd like to add on one other story, because you've got two people on the panel who last night has directly been impacted on the running business. Just like yourselves, we had a deal on the table that we've negotiated for the past 2-3 months. We did have a Brexit clause. And I haven't spoken to my team this morning, because I'm obviously sitting here. But I assume that we will pull that clause. And that's a big deal. I mean, it's literally a big Euro deal. So that deal is not...
In London.
In London, yeah. So it's a London deal, Brexit clause, we won't pull through. And I just got an email this morning, so it's been a lovely morning so far. We had an asset that we were selling in Brussels, and the seller stepped back this morning due to the result. So this is just two parties, and there's unfortunately a lot of people involved in deals at the moment. And I'm sure that this week I've canceled all meetings for next week, and I'm staying in Hamburg just to sit down, run through the running deals, what are the implications. And honestly, we did not expect this at all. Just like the markets didn't expect it, the bookies didn't expect it, except for Richard, who made 7,000 quid on the back of this disaster. The only happy guy in the room.
Just hedging my currency. Shame it's in sterling.
Yeah, it's okay. What a broker, eh? Playing both sides. There you go.
50-50. 50-50.
He voted to remain.
Yeah, but he bet on leaving.
Shame I won't have a job tomorrow.
Like, we're back in the days of Goldman Sachs. Tell your clients to buy A and says bet on B. Richard, you did learn something out of 2007. I'm just realizing. Yeah, well done. So, but indeed, what you see is that the hold will be certain for the next couple of weeks. And the question is, how quick is movement going to come back into it, and where's the reliability? And again, you got to look up. From up to down to all because it's new land, so we don't know where it's going to go. There's so many different disparities of where Britain will go or where Europe will go. You've always got to remember, we're talking, and I've got the numbers here just because I can't get them out of my head, because the Handelsblatt, which is the most important economic paper in Germany this morning, just for some numbers in your head, the European Union is now losing 20% of its GDP, 13% of its employees, and 10% of its soldiers. That's the impact of just Britain leaving in the one direction. Yeah? And on the other hand, if you look at the other direction, you've got to be realistic on will Britain have any kind of a negotiation power towards the euro? There's a political dimension there. Why would they? Why would the euro now say, all right, guys, you left, we'll give you the best package that you would have, a better package than you would have gotten if you remained? Every other country in Europe would then go exit. So it can't happen politically. And plus, who's going to invest into the UK in the next 2 years while the negotiations are ongoing, not knowing where it's going to go? So there'll be a stagnation. Is that a stagnation out of itself? Is it a stagnation as a holding period? So there's a lot of uncertainty there. The lights aren't going to go out. Britain will still not, or England will still not win the Euros. That's definite as well.
You're right.
Wales might. Now that'd be funny as hell, actually. Or Northern Ireland, and then they'll exit, which I think is fantastic. So there's some certainties that remain, yeah, and it was a rainy day yesterday. Unfunnily, strangely enough, it was a rainy day yesterday and a sunny day today. So, you know, it's 48% or 52% of the people are quite happy this morning in Britain. So let's just hope that it doesn't cause the wild reverberations in a world that we're living in that is extremely tightly strung. And small little tremors can turn into, you know, big waves at the moment. And I hope that there's a certain calmness, no matter how disappointed and sad I am personally about this decision, because I've got to tell my kids, I grew up in a traveling free Europe, of a united Europe with peace. And in these bad times that we're living in with a lot of threats to go along with it, when he's 17, he's going to go, well, how come I don't have that anymore? And it's sad that view was so badly sold.
Just one thing on
Enough of me now.
This is one of the easiest things I've ever had to moderate. Just carry on, guys.
No, Richard. But
why do you have a seat? Well, Richard, why don't you sit down? You might as well come over and sit down.
We're all lucky enough to live in democracies, but of course the turnout was 72%. Yeah. So 52% of 72% voted to leave. So if you understand, it is not the majority of the people who could have voted. Some people didn't vote, partly because it might have been raining.
Well, it was 72% of the eligible people who were allowed to vote, and out of only 50%, and not 50% of the population. So effectively, but then again, Margaret Thatcher went through votes like that with 25% for years. So when you look at it, it's not the majority of people who could vote in the UK voting to leave. It's gone now, it's happened, but it's... democracy.
Yeah. Okay, well, let's move on to some of the real estate issues.
Let this be a good thing that could happen in the US with Trump, yeah? So,
exactly.
Start voting now, start rallying.
Let's swing it over to Trump, yeah. So I suppose just to set the scene, what you're going to remember with European real estate is each country is recovering at multi-speed, and that's, even though they're in one single currency, it's up to each country to look after its fiscal and economic policies, which maybe is not the way forward going forward, but it is. So we have 70% of all capital markets investment volumes are still based in London, the UK, Germany, and Paris. So even though you hear big stories about what's going on in places like Ireland, Spain, the Netherlands, actually the big markets are the UK, Germany, and Paris. And that's still the case. So and it's generally the most liquid, transparent markets with global reach, and the economies are slightly better, etc. So I just want everyone to bear that in mind before we move on. So what I'm very, very intrigued to know, Philip, first of all, is you know, what is Union's thoughts sort of pre-Brexit, and what are your thoughts post-Brexit? So are you going to be pulling out your deals, as you say? Do you feel that you're going to be heavily investing in Europe? Do you feel some of the money might go to the US now, etc.? I'm really intrigued to hear what Union investment might do.
I'll be very intrigued to hear what we get to at the end of the day. I mean, look, literally, I'm looking at my watch. This is 4 hours ago. And as big companies go, two things that you need to keep. You've got to stay calm, and you've got to start seeing things in perspective. We're not going to have rash reactions. And I think even our London deal, I hope we're not going to have a rash reaction on that either. And we literally did not expect this. I was on a panel last week with you, I think it was as well. We were saying this isn't going to happen. I mean, this is ludicrous. I mean, but it just shows you what kind of bubble that we're in, and the fact that no matter how many percent, but in a democracy, the majority don't want a supranational state that isn't accountable in the direct sense. So for us, what will happen, or this is all assumptions now, and this is, you know, this better not be recorded. Can you turn that off? Prior to Brexit, we would have said if there is no Brexit, I mean, it wouldn't have been business as usual either, because it would have been the impetus to have some kind of a change or discussions on Europe anyway, no matter how tight it would have been. There was no way that couldn't have just been left on its own. So the whole discussion there would have potentially been seen something positive, reform it, try to do something with that danger in the air. You now have a situation where, and we would have kept investing as we are, and the amount of net capital inflow that we've had the trust of our investors, so real estate still remains as an asset class that people favor presently. What you now have, and this is my guess is as good as anybody else's in this room, you have two different situations. The one thing is, as I just stated, is the weakening of the remaining European Union. And let's just look at the economic side of it first. And you have Britain. And as I said before, stagnation is probably the most likely scenario in the UK. For real estate, what does that effectively mean? There, I think the impact is going to be slightly higher, and I hope it's only going to be a short-term, medium-term dent. I do not see a lot of players investing into the UK now. There may be opportunistic capital waiting on the fence to swoop in and try to use that situation, hopefully pricing it with the according risk to go along with it. That will probably take some of the pressure off the yields, but you've got to remember it was a steep yield to begin with in Britain anyway. So this may be a catalyst, hopefully not one that spins out of control. And the leasing side, again, stagnation, and that's the more dangerous effect, I think, is the long-term view. The one is the reaction of investors to something uncertain. The other one is the reaction to, depending on how these contracts and the expanding country and all the impact for the GDP that will go along with it, if that impacts leasing markets, then that could be a danger. And that's more than just the financial impact of London at the moment. And let's be serious, London will still be the financial world market even outside of the EU, or it will be. That was I'm certain of that, just like I was certain of the fact that they're not going to leave. So you never know.
No,
but
I think on that
point
point there, I mean, some of the banks, particularly the European banks, will move part of their function to Europe just in spite.
Yeah, we've got 700,000 people in financial services in London at the moment. Take 10% of that movement, 70,000, and a consolidation on the continent as well. So you'll have a moving around. It's not going to be Frankfurt only. It's going to be Frankfurt, Paris, Amsterdam, Dublin. They all have a certain amount. So you divide that up, you get 10,000 people. That's 100,000 square meters. It's not going to make a big dent or an impact. It's not going to boost Dublin up into something. Now let's go to the continent. So UK for us is going to be a difficult one. I do not see us investing into the UK at the moment, which was one of our bigger markets. So we would probably react on that and look at US now and Asia. Asia, again, if you're trying to buy at 2%, it's not making a lot of sense. So the lot of investment that we've done in the US will probably increase. And we'll look at the continent, which parts and what type of asset will be going to developments like we have, speculative developments in Barcelona and Dublin. That's a tough one, because I don't know where things are going to go. Will Dublin improve? I don't know. I have no idea. And if you have no idea, it's better to try to hold back. And again, you've got 20% less GDP in Europe at the moment, and this is an indication, and here comes the political side, if the dominoes start to fall, what are you investing into? Is it the end of the euro? And if it's the end of the euro, you're going to wake up one morning with 12 different currencies again? Are you going to start investing? And the reaction to that will be, with the continued force of equity flowing into these markets, it's going to go Germany. And the prices there have already skyrocketed anyway. And there is no product out there because nobody's selling core at this moment anyway. So for the few bits and pieces you get, they're going to get hammered with capital. And this is just one aspect. So I could do this all day, by the way. Lean back, relax, have a coffee.
I want Alistair to have a chat. So Alistair,
please.
Obviously, you're dealing a lot with Southeast Asian clients, investing all over the world. I mean, what are their views? Are they taking a more longer-term view? Are they more concerned about what's going on in their own economies, etc.? Really, I suppose.
I think it's a bit of everything. That's the problem, and this is just another leg of uncertainty they have to throw into the mix. So look, let's just try and put it simply. They're primarily all about yield. The investors from Southeast Asia, as you well know, and you know as well, it's not really IRR or equity multiple driven investing. It's basically a certain amount of leverage produces a certain amount of cash on cash dividend for them. That has done very well for them in their initial foray into, say, the UK markets, where they could obviously secure long-term contracts, good buildings, and very little management. They are very, very light touch managers. They actually prefer to have a partner or a manager who actually they can trust in to basically run that asset for them. So they've had a very good run in the UK, but then they had a very big sort of shocked the system by the fact that a lot of them are also driven by oil prices effectively. And so, for example, Malaysia had a really significant devaluation in the ringgit. And that led to some pulling out of the markets from the Malaysians. We've seen it very much in London as well. But the ones that stayed in the game, and I'll answer the question directly, they are long-term investors. They can go through this cycle because they actually want to buy long-term secure income. So, for example, the medical transaction we did had 35-year lease contracts with annual indexation, and it was about $1 billion trade, so it was a significant amount of capital they put into it, and that was just the type of asset that they wanted to secure. Very long term, they'll never sell that group of assets. So that gives you an idea that they are, by their nature, long term. Problem is, and the point we didn't touch on, we touched on it outside of here, is the thing that really worries me is we are a country of 64 million people. And you guys have been down the Thames and you've been to the Tower of London and got locked in it and blah, blah, blah. But we have some quite big cities outside of London. We have Birmingham, we have Manchester, we have Leeds, we have Edinburgh, Glasgow, Bristol, Nottingham, Cambridge, Oxford. But none of these investors actually want to go outside of London and the southeast, except for logistics. And you know, I could, like you, I could bore about logistics, about how much they want to buy logistics. So it's the death nail for the regional market for investors, in my opinion. I really don't think that getting them over Brexit, one, and then actually saying, okay, well, it's long term, don't worry, you can be in London long term. West End will still be there, it will be there. Midtown will still be there. City, probably a little bit of a hiccup there, probably not so much. Canary Wharf, another sort of intake of breath. But there are markets within markets which they'll take a long-term view on. You get them to take a long-term view on Manchester and Birmingham, waste of time, in my opinion, because it's not, the lot sizes aren't big enough, and it's regional, and they just don't want to deal with that. So where's it going? And I'll answer the question directly. At the moment, and when I talk about Southeast Asia, I talk Malaysia, Taiwanese, Chinese, Korea. That's the sort of area that I cover. I think with those groups, in the UK, there will be long-term investors who will just say, I'm fine with it. I am buying a long-term contract from a qualified covenant, and I will ride it out because I'm getting a 6% cash-on-cash yield. That's fine. Logistics, they will still try and buy because they can, and it's just an asset class they're very late to the game of, and they want to buy more and more of. It then migrates to the point you were making is, and I'm quite sort of, I throw away lines, but I think France is a basket case economy, right? And I don't actually understand why people want to spend a lot of time investing in France. But Germany is going to get, as you said, absolutely pounded by capital. All the gateway cities in Germany at the moment are being actually just hunted down as basic locations for Southeast Asian money, the family offices, the big institutions in Germany. They're all trying to buy in Germany. Only one thing's going to happen in Germany, the price is just going to get ridiculously expensive. So I think that from the Asian side, at the moment outside of the UK, and there's still going to be people participating in the UK market, Germany, France, possibly, but it's very opportunistic in France. The rest of those countries, they don't even do the homework on Poland. You know, Poland's a big economy, lots of opportunity there, haven't done the homework, can't do it. Too complicated. So, you know, and then you do the peripheral ones, Spain, Portugal, Greece, you know, there are opportunities, but not for these guys. So my final answer is, I think the money is now also going to hunt much more in the US. But the problem for that, for all of these funds, is they absolutely hate the American tax system. I'm sure you all do. But they actually hate it because they don't like having to open up their books to the American tax system. So the only way that they can structure, there's a lot of many, many different ways they've thought about entering the market. The one that does seem to work is take a minority interest in a group of assets in a partnership and effectively give all the management back to the partner. So it's a little bit like you sell it but still own it type of approach. And that is where they will want to invest more and more in the US. We've had 3 visits recently from Southeast Asia into the US, ranging from $1.5 billion portfolio in Manhattan, Amazon in Seattle, a logistics park, hotels across the US, food-anchored stores, portfolios of 300 or 400 million. This is where I think their capital will move to. And I think it won't take them very long to find the right partners in those markets. I think at the moment they're going up a learning curve, and it's, remember, they don't know, you know, Boston, Massachusetts from Boston, Lincolnshire, you know, to make an analogy.
Birmingham, Alabama.
And I think that, you know, they need to be educated, they need to find the right partner. That partner, if they want to do a transaction with these Asian partners, also need to be patient. These guys are not going to be beaten into a deal. They need to understand, but they are then a very, very passive partner, which I think is a very good partner to have, because you can do repeat business with them if you're into logistics or you know, food retail or whatever it might be. That's where I think the capital goes. So it's going to be still a bit in Europe. Germany's just going to get, even now they've got nosebleeds in Germany. They go, that is really expensive. Some in the UK, some a little bit about Europe, but very, very opportunistic. And I think much more into the US with the right partners, finding the right assets and actually being patient and working with them.
No, I agree. So, John, with your advisory hat on, so where do you think we are in the European cycle? I mean, obviously, I've noticed a shift of people going into income. You know, I think people are a bit concerned of the geopolitical risk going forward. So, you know, with your advisory hat, I'd like to get a feel of where we are in the market and what's your views on the leasing market, etc.
I think, obviously, do tell. Well, I think the geopolitical risk, obviously, the last few hours have sort of, I don't think anyone has a clue really what will happen. I think it'll calm down more quickly than people maybe feel at this very moment. I think we're all still in shock. 3 things, if I may say. One is, from a global point of view, and we're coming to Europe at the moment, Richard, that's okay. On the global point of view, I did some work with the Qataris on Canary Wharf, and they bought it with Brookfield, which is who you know well. And on the back of that, they've taken it private. It's a very big scheme, you know, Canary Wharf scheme. And on the back of that, they wanted to go into America. And gosh, you know, there are people here from much bigger firms like Colliers, CBRE, Jones Lang than little old me. But at the same time, it was the tax issue that interested me, that going to America, people like that find it difficult. With regard to the global element of it, it is interesting how America, where you want to invest and will invest, of course, the tax issues are a big problem. In Europe, I do quite a lot across Europe, not as much perhaps as Richard, but I do see that it's cities rather than countries nowadays. In my older days at GIC, it was countries, so you'd analyse France against Germany, Belgium against Spain. And now it tends to be Paris, if we're talking about France, if I may. If we talk about high values in France, it's really Paris. London we've touched on, and I take the point about the regional UK. Although the point I'd say about that is that, and Farebrother, who I do some work with on the occupational side in central London, the rents now in central London, occupational costs, are very high. And so you've got, as far as the UK is concerned, American companies, international companies, UK companies, who are attracted to send staff through to the regional cities simply because it's more affordable. Not just for the office rents, but also for the younger people going to school, for their children buying houses, etc. So London has become expensive for that reason. The other part about it, I would say, is that if you look at, rather than touch through every country, they're all going at different speeds, and then you get into this thing about the euro, etc. I worry about the occupational side, about the UK we've touched on the investment side, but actually international employers like BMW, for example, or Asian Honda, all these global employers into the UK who, I don't know what will happen next, whether they will take a slightly different view or whether it will hopefully be business recruitment as usual. There's been this backlash. One of the quotes has been, well, great last night because it gave Goldman Sachs a bloody nose. That was one of the things. One of the one of the comments you hear is that, well, of course, big business was saying Britain should stay in, and Goldman Sachs and Mr. Diamond, etc., all say you should stay in. Of course, now we've given, we've shown them that we're going to leave. But of course, these are very big employers, and not just them. But then you feed down through all the professionals. We were touching on earlier the fact that it's probably the lawyers who are probably going to be the busiest and the most beneficial to the next couple of years, structuring contracts, and we won't go certainly into that. But I think the other part about it, I would say, across Europe is that I spending time in Paris, I don't quite understand why it's so expensive, but you have people who want to go there and buy property like they buy art almost. They don't look at the IRR fundamentals. Spain, I do a lot in Spain. It is Madrid and Barcelona, but again, gosh, they've got a general. I think we're all tired of elections now, but they've got a general election this Sunday. Yeah, this Sunday, and no one really knows what's going to happen there.
Left populist, probably.
Podemos could do very well. And they're a 2-year-old company. Political. Sorry, we're all tired, aren't we? They're a 2-year political party. I do apologise. The other part, of course, you then get into the returns that one gets. If I'm back at GIC, and it's like with Union and Alistair's some wealth funds, real estate does give, in many cases, a slightly higher return than you get in bonds and gilts and other sectors. So before you know it, conversely, you say, well, actually, real estate, it gives me 3, 4, 5%. It's more attractive. Then, of course, you've got the hit on sterling today, and of course, that will make the American opportunistic funds, I guess, they can buy more property for the same dollar. So again, then you say, well, actually, does that make the UK more cheap? You can go around in circles as to the implications, and I think leave it at that. But I think the summary for me would be that already I think the UK economy was beginning to slow down last autumn. The real estate market, the residential market, particularly in London, has begun to cool last autumn. This spring, the commercial market was beginning to cool in many ways. So I think this referendum and the uncertainty of the last 6 months couldn't have come at the worst time. The Tories, just a little bit of commentary, and you probably know this, that David Cameron promised a referendum. Why? Because he wanted the right wing of his party to stay with the Conservative Party rather than go to what they call UKIP. So he promised this referendum to allow the Tories, and it turned out they got a majority. Probably, and I know David Cameron and Boris Johnson quite well, probably he didn't expect the Conservative Party to get a majority. So he thought it would be another coalition where the Liberal Party, this other smaller party, would then say, you can't have a referendum, and there wouldn't have been one. So ironically, when the historians get going, I think you might find, ironically, that it was never David Cameron's intention to have a referendum yesterday. It wasn't. He thought they wouldn't get a majority, and then he could excuse the fact that because the Liberals wouldn't allow it, he wouldn't do it. So when he got a majority of 15, suddenly he had to honour his pledge. And I think now he's losing his primary. He would have gone on for a little longer, I think. He's been caught out with that, but we're not here to talk politics, we're here to talk real estate. So my summary would be that real estate will continue to be a balanced asset. We know from across the world that real estate for all of us around here is always going to be attractive. And the UK, one other thing I may say, Richard will know this from Colliers, is that some of the UK real estate retail funds were beginning to get redemptions coming through, I think, earlier this year. So they'd actually begun to stop investing in regional and London property. They were selling to and so it's actually a bit of a perfect storm without George Clooney, I think, because you've got this sort of the slowdown in the real estate market. But other markets, Brussels, Dublin's bounced back, Madrid's bounced back. A lot of, I think, cities around Europe, wow, I think it could be quite exciting for them, that they will probably get more employment through from the implications of the last 24 hours. and more investment. But it's as Philip said earlier, it's small. It's not going to have a profound effect, but I think there will be that ripple effect.
Oh, that's right. Yeah, no, so I appreciate that, John. And I mean, just finally, before we open up for any questions, you know, Philip, obviously we're seeing prime yields in London sub 4%, sub 4% in Munich, sub 4% in Paris, even Prague, even Warsaw is at 5% today. So the weight of capital's really, really driven down pricing, as we all know. But do you still see any value in core assets? Or you know, are your investors having to, I suppose, change their return requirements?
I think value nowadays is a matter of perspective. Yeah? And the matter of perspective is it's security trading off ideologically and hopefully a lower risk. And I think that's the true amount of capital going into these markets at the moment are not real estate driven. They are alternatives to a non-alternative investment product. There is no fixed income, and there's so much money in fixed income that needs to get some kind of a return. I mean, every German insurance company, pension fund, etc., has to have a certain percentage in fixed income. And that is in Germany now at 0.02% for a 10-year bond. So you need to get something, and the next stage of risk is real estate. If the next stage of risk is real estate, the only thing that they're going to buy is core. And now you flip that back to Brexit, that sense of security is going to increase even more now. So the pouring into the core part of the market is going to increase ever more, simply due to the fact that I need more security now. And that's driven by the country like Germany. It's going to be driven in the asset class, because you don't know where things are heading. And you've got to be very aware of the fact that this can be the first stone of a domino effect. And literally, I'd be absolutely amazed if it isn't. Yeah. And two sides of that again, to what I said in the beginning. The UK is unlikely to get a good deal out of this Brexit, because it would then most certainly tip off the second stone. So that's the 2 years there. But on the other hand, the Le Pens, the Wilders, etc., the AfD, they are going to pound that issue of we want to vote now as well. So trying to keep that glue together is in that period of time, and that's a 2-year period. And again, there is no alternative. I cannot see the German bund rising at all. It's going to get hammered even more. It's going to go even lower. It's going to become even more negative. So your spread to your fixed income keeps increasing, even though your prices for real estate are decreasing. And it's not a real estate issue, because people aren't looking at the fundamentals. So it's longer leasing, good locations, you know, battering in for the worst. And then the question is that the only market going to work? Because, hey, 7 years ago, post-Lehman, guess what? The only thing was that sparked off the markets again? It was core investors going into core assets. And then the fringes started working again. And now you think you have a working system, which isn't quite true either. It's still a very conservative capital inflow. You've got some opportunistic capital on the left, and you've got that moves into these markets, but essentially it's still a conservative drive. Why? Because the background is all I need to do is get above 3% and I'm in, because the alternative is that's 300 pips. And they only look at light management, call it that, from Asia, call it German conservative capital, and that we are the exact opposite of opportunistic capital. So that's driven by that anyway. Institutional money that's flooding these markets is going to be the driver now ever more. So these discussions aren't done yet, but one thing is for sure, lower for longer on the continent. I'm sure there's going to be stagnation in the UK. And in a normal past world of 43 years before this referendum, whatever happened in the UK, they went to the market, went to the continent. So again, stagnation in the UK, the overpricing of the market. There used to be a perfect line to what will then happen in Europe. That may be different now, but if that hits Europe as well, so the leasing, the only value that you're getting out of your market to now, or out of your assets to now answer your question, is your leasing side. It was anyway until today. So will there be further inward yield shifts on the continent on the back of, again, trading's been down 50% almost, or 40% in the UK. The UK makes up a third of the trading in commercial real estate. If that decreases further, and it's bound to say 60, 70% drop, the same equity sources are still there, they go over to Europe, prices increase. I mean, it's a relatively basic idea behind it, and they're only going to go for the safe stuff. So there might be value in core because your yields are going to increase, are going to be compressed further. Is that a long-term play? That kind of depends on how the EU is going to react. Is it going to fall apart? Are they going to go closer together? Is there going to be referendums? If the next 3 referendums spark, they only have to be announced and given way to. You then have a falling apart of that issue, then that capital will finally disappear out of Europe. And God knows goes into where. But if you then have that happen, your bond yields are going to increase as well. So, you know, some of the pressure is out of it. And then we haven't, that's a pure reaction of capital. Underneath that, you have, funnily enough, you still have a real economic issue as well, or not, depending on which way this thing might go.
Yeah. So,
sorry,
yeah.
I think my background, as you know, was opportunistic investing, and I think that the point you made there is it's very hard to imagine where, you know, these funds are big now, you know, the Blackstone funds, and they're massive.
Yeah, of course.
Where are they actually going to put their capital now? You know, because
they have 25 billion to yet invest in Europe or globally.
And what are they going to do with that? You know, it's going to be so, because even though, you know, you could see that creep of like saying, well, actually now that model's bust, it's time for the opportunistic guys to have a go at it type of thing. Well, no, that doesn't work like that, does it? It doesn't.
You can't put it into equity. You can't put it into funds. What's left? It's Tina. There is no alternative. It's going to keep pouring in. That's the question. That's what we were saying last week. If it does come, will the wall of money reduce the effect of a Brexit on the continent? The UK itself, you can't help that issue at the moment. And I have to admit, well, it's self-made, so deal with it. And honestly, I'm not in tears about it either. Get stuck in your own muck. And long term, Britain has, you've got 70% of your GDP growth is services. If it's stuck on the island, you're not going to need 70% of that. So you better damn well get a good agreement out of the EU. And supposedly, because UK is so very important globally, you're going to have these great new trade agreements with the rest of the world as well, because that's exactly what China has been waiting for. And nobody ever asked that question.
We've got a history of global trading, so hopefully...
So, but I fully agree. Where's that capital supposed to go? But it's got to disperse somewhere. And finally, maybe, one thing that we've got to be clear on as well, our little Italian friend, Mr. Draghi, who's been left out of this equation totally so far, what's his reaction going to be? Lower for longer, maybe, but is he going to go into equities now? Does he have to go into equities? Is he going to go into, I mean, literally, is that what's going to happen? And he's been pushing a repricing of the market over the past 2-3 years anyway. These markets would have consolidated a long time ago if, you know, the crack-addicted equity markets haven't been, you know, just getting their dope on the corner every morning. So there's so many ifs and buts and questions out there, and usually the reaction to unknowing is pull back capital. And is that going to be the case? How long can you bottle that up? When's that cork going to come flying off?
So I think everyone can see, I think we're almost out of time. So I think you can see it's a very uncertain market going forward, but probably be for the benefit of the US. But just to open the floor very quickly, does anyone have any impending questions? Yes, please.
Hi. So in terms of this, this impact of Brexit, do you see investments getting transferred to the Asian market in terms of specifically to India, because it's an emerging market at this point? I mean, you mentioned about Blackstone, where they invest. I mean, they've got an early mover advantage anyways in India right now. They've heavily invested in a lot of assets within India right now. And we're actually a very fast-growing economy, the fastest in the world right now at 7.8%. Our Prime Minister is very proactive with a lot of governments and trying to get investments in the country. So apart from the US, do you think India would benefit, or would you consider investing in that country?
Can I just start? Because Sajid, obviously, CORFAC, which is this international group, you are the Indian
keep plugging it, John.
No, just to put in background who Sajid is.
So union investment, right?
So I suppose my first point is that you by default, and I think what we found in the last 12 months is that because coming into Germany and Paris and the UK investment was quite difficult, and you're the expert, the money was looking outside that into the other parts. So Dublin came back fantastically well, Brussels, Spain, which is close to me, but the capital cities. So I can imagine my bit on that would be that India would benefit. Yes, you're right, it's a democracy, and I think as long as it's transparent. Because don't forget, one of the brilliant things about the UK and London over time has been very transparent legal system, title, etc., etc. That's one of the attractions of liquidity of London.
I think it's a lot with liquidity. So Central and Eastern Europe is, everyone talks about why is not all the capital going over there. Their economies are growing. But a lot of those countries don't have local funds. So if the world goes upside down, who the hell's going to buy them a property? And that's what they're suffering. So they're still lacking a lot of depth in some of those markets. And investors are very, very wary about that, in my view. Yeah.
I think from an Asian perspective, a Southeast Asian perspective, it's never been a topic of conversation, to be frank with you. And perhaps I invested money when I was at Deutsche in India, and I think the transparency issue is a very significant one, particularly, and I'm not sort of calling the kettle black, but there's a lot of transparency issues in Southeast Asia anyway. They've had to continue to look at themselves in the mirror and say, am I really that transparent? I think that, my advice, in inverted commas, would be there is no, as you talk about the economic growth and the opportunity, it's a little bit like people need to be educated about those. Because, for many people, the one thing you'll always say about Asian real estate groups, the investor group, Richard, John, you know this, no one works there. There's like 3 men and a dog usually, and they're running 280 billion of assets. It's crazy. They just don't have anyone working there. And so, to get that little bit of a moment with them is hard anyway. And my advice would be, if there are opportunities to attend conferences where they are there, the people are there, to buttonhole them a bit, to get their interest and to talk to them about it. That's the way you'll start to engage little by little. Because, their in-tray is massive, and, 99% of it is of no interest because it's not in the UK, Germany, France, or the US or Australia. You've got to get on their agenda.
Yeah. I know we're over time.
Would you like an investor answer?
Yeah, exactly.
I can only pitch into the same issue. Transparency is what hinders us to go into India. I'd love that market to become more transparent, to suck in some of the capital that is simply overpricing the rest of the world. I was at a conference last week. It sounds like I'm only at conferences now. Yeah. I think that's all I'm going to be doing post-Brexit anyway, so I might as well get used to it. I started hosting these
There's
things.
No deals to do, just attend the conference.
Sounds like talking about it, making more money than actually putting it into these markets. Okay. And there was 110 investors, so there was 2.3 trillion represented at that table or at that conference. And it was the same question. There was a question emerging markets, and there was one particular one to India. And it was 75% won't invest due to transparency. So that's the true issue. And there was 2 or 3 there who've had experiences, and they didn't really convince anybody else to go into that market yet either. Yeah? It'd be fantastic because demographically and economically, etc., and simply to get over there because it's such a beautiful country. It would be great, but I think it's going to be the generation after us to do that. Hopefully.
Yeah.
Can I just... Sorry. Another question?
Yep. Sorry, we got one more question at the front. Yeah.
When many of the northern European countries adopted the euro, it was my understanding that their currencies lost a lot of value, like the guilder in half in Holland. Wouldn't the same thing happen in reverse to the benefit of northern European countries if the EU did break up? That both currencies in the north would rise and real estate values would go up and the south would be punished?
So, first of all, the Gilda is Dutch, and that's not really that far north. But on principle, Finland, I mean, the European Union at the moment, and that's its difficulty, is a transfer union from north to south. So you take it apart, and that's exactly what would happen. But you take Italy apart, and that's exactly what would happen. If you take the UK apart, north-south, that's exactly what would happen. But that's not a violation. You take the US apart, who's going to keep financing Louisiana, Tennessee, and whatever other state? Hope there's nobody there from there. Sorry. Great food, though. Great food. But that's a natural reaction. You take the US. There is no state where everything is perfect if it increases a certain size. And the imbalances are what political systems and economic systems are there for, to keep them in a balance and to have, on a national or supranational basis, to support one another in those boundaries, in that border, or in that boundary of a supranational organization. So, of course, you take that apart and you put new currencies in, you know what's going to happen? The Deutschmark is going to be worth, I don't know, £3 probably, first reaction. Or come up to the pound, or be just above it. And the lira is, if it does come back, is going to, go back to whatever they had, thousands, wasn't it?
Oh, God.
Yeah, I can't even remember, yeah? Or the pesos, yeah? I mean, you take these back, these very things. It would make my world hell, yeah? I remember traveling. I mean, I grew up in this world of many currencies. I used to travel. I remember my assistant always packing my back when they used to do that, too. Yeah? So talk about life-changing, yeah? Not my bag, just my work bag, okay? My ex-girlfriend used to pack my bag. My wife doesn't do that either. Yeah? So, and people ask us why looking forward looks worse. Okay. And the amount of currencies she used to pack traveling around, and I'm sure I was always the one losing. It wasn't the company traveling and with that amount of currencies. And I still have them in this big sack. I'm glad I still have them. Yeah. They're going to be all new, though, and it's a shame. But my kids look at it, and my kids look at these currencies, they're like, wow, that was pretty cool. But I say, no, it's just a big hassle. Yeah? And visas, etc., and getting in, and it's just the passport controls. And just my job, being a pan-European investor, it's the worst-case scenario. There's nothing good about it. And yes, currencies will flip. And look at the way that currencies are impacting investment behavior now. You do that within Europe, it's not going to be a good thing. And yes, the north will rise and the south will fall, and the assets there will reprice, and the other ones will depreciate. Yeah,
I quite agree. I am aware we've just run over time, so if there's any other urgent questions, we'll all be outside if anyone wants to have a chat.
Can I just make one comment, Richard? This image of Boris Johnson and Donald Trump, if it's all right, it could be Hillary Clinton and Theresa May. Okay, just forgive me. I had to say
looking ahead.
We leave it at that.
No, but I'd like to thank a wonderful panel today. I know we haven't covered much, but Alistair, thank you. Philip, thank you. And John, thank you very much.